All right, today we're going to follow a single dollar on its journey through a business. We'll track it from the workshop floor all the way to the stock market, just to understand how these companies really work and how they tell their financial story. So let's dive right in.
This is the one question that really drives everything. Investors, founders, you name it. And by the time we're done here, you'll get the fundamental language businesses use to even begin to answer it.
To get our heads around a billion-dollar company, we have to start small. I mean, really small. Let's pretend our company just makes simple wooden chairs. So what does it actually cost to make just one of them? Well, the answer is built from three main ingredients.
Okay, first up, material. This one's the most obvious, right? It's the physical stuff the product is made from. For our chair, that's the wood, maybe some screws, a little varnish. Simple as that.
Next, you need someone who can turn that pile of wood into a chair. That's labor. This is the money you pay for the carpenter's skill, their time, their effort, basically the hands-on work of creating the thing.
And finally, we have overheads. Just think of this as, well, everything else you need to keep the lights on. The rent for the workshop, the electricity for the tools, the insurance, all the stuff that isn't in the chair itself, but you absolutely can't make the chair without it.
Now, accountants split these costs into two buckets. The wood and the carpenter's time for one specific chair, that's a direct cost. You can point right to it. But what about the factory's supervisor's salary? I mean, they're overseeing hundreds of chairs. You can't pin their whole salary on just one, so that becomes an indirect cost. And believe me, this difference is super important for figuring out how efficient a company is.
Okay, so we've got the cost of one chair down, but businesses aren't thinking one item at a time. They have to see the whole picture, all their costs over a whole year. And that's where things get really interesting.
So here's a crucial point. Not all costs behave the same. The rent on your workshop, that's a fixed cost. You're going to pay that same amount whether you make one chair or 1,000. But the wood you buy, that's a variable cost. The more chairs you make, the more wood you buy. It's that simple. And honestly, managing the dance between these two is the secret to running a really smart business.
So a company has all these different costs, and hopefully a bunch of sales to make up for them. But how do they wrap all this information up and share it with the world? Well, they use two main documents to tell their financial story.
First is the profit and loss statement, or P&L. The best way to think about this is like the company's report card for a certain amount of time, say a quarter or a year. It's a moving picture that answers one very simple question. Did we make money or did we lose it?
And this shows you exactly how it works. You start at the top with your total sales. Then you subtract the direct costs of what you sold. That's your cost of goods sold, which gives you your gross profit. From there, you subtract all the other expenses, marketing, admin, you name it, and what's left at the very bottom is the net profit. That's the number everyone's watching.
The second key document is the balance sheet. Now, if the P&L is a movie about how the year went, the balance sheet is a single photograph. It's a snapshot of the company's financial health on one specific day, showing everything it owns and everything it owes.
And they don't call it a balance sheet for nothing. See how the two sides are equal? They always have to be. On one side, you've got assets. That's all the stuff the company owns. On the other side, you see where the money for that stuff came from. It's either liabilities, which is money it owes to others like a bank, or equity, which is the money belonging to the owners. Assets must equal liabilities plus equity. That's pretty much the golden rule of accounting.
Okay, so companies publish these big, kind of complicated financial statements, but how do investors or bankers or even you and me figure out what's really going on? How do we read between the lines?
Well, the answer is ratio analysis. This is like the secret toolkit that analysts use to check a company's health. You basically take numbers from the P&L and the balance sheet, compare them to each other, and suddenly you can uncover these incredible insights about how well the company is doing.
And the king of all these ratios? It's got to be return on investment, or ROI. It is so powerful because it connects the P&L through profit with the balance sheet through capital employed. It tells you exactly how much bang the company is getting for its buck. It's the ultimate efficiency score.
And just look at the story a simple ratio can tell. Old Guards Co. spends 56 cents to make $1 in sales. But the smaller company, Young Ones Co., is way more efficient. They only spend 49 cents. That little difference shows they have a much better pricing strategy. The ratio tells you instantly who has the more profitable business model.
Which brings us all the way back to the very beginning. We've seen how costs work, how companies report them, and how we can analyze them. So now, finally, we have the tools to tackle that ultimate question. So, figuring out a company's value isn't magic. It's a process.
To get a fair value, you usually look at it from two angles. First, the net assets method. That's basically asking, if we sold everything and paid off all our debts, what would be left? The second is the yield method, which is all about the future. What's the company's power to keep making money? The true fair value is often found somewhere in the middle, an average of what a company has and what it can do.
And that really just nails it, doesn't it? These numbers, these statements and ratios, they're not just math homework. They are, as the source material so perfectly puts it, the language of business. It's how a company talks to the world, how it communicates its wins, its losses, and its potential. So you now have the basics of this really powerful language. You can look at a company's financial story and start to see the plot, the characters, and maybe even a glimpse of the future. The only question left is, which stories are you going to read first?